Hey everybody, Smart Silver Stacker here. Welcome to another live stream. High inflation is not going to interrupt gold's price breakout, but today we did see higher than expected inflation data released for February, and as a result it does appear to have at least interrupted gold's price breakout. But we're going to talk about why that's not going to be a trend that is sustainable. In fact, ultimately, higher inflation is going to lead to a massive continued breakout in the price of gold. When this becomes apparent to investors, I think that is when silver is going to follow suit. So we're taking a look here at the long-term chart of gold. Of course, there's this cup and handle pattern, which has been forming for more than a decade. We've talked about this many times. Now I'm going to zoom into the handle here, and I want to take a look at something because, you know, what's happened here is we've broken out of this critical resistance line just under 2100. The price has spiked up. We've exceeded even the previous intraday high around 2150. That's also a critical point. Now, today's inflation data, I mean, it's the typical thing. You know, you got hotter than expected inflation data. Surprise, surprise, even according to the official numbers, the CPI that is compiled by the government. In fact, let's take a look at that real quick, and then we'll come back to this chart. So you've got the CPI up 3.2% year over year, 0.4% for the month. You've got the core CPI, so minus the volatile food and energy categories, you know, the stuff that most people actually have to buy. That's up 3.8% year over year, up 0.4% on the month, higher than expected, 0.1% for both of those numbers, higher than expected. Energy costs are beginning to move up again. That is contributing to the headline number. But anyway, I mean, look, put a 1 in the chat if you agree with me that these numbers don't really reflect the actual level of inflation in the economy. I mean, these numbers are going to continue marching higher. It's incredible, really, that the rigged numbers, which are designed to understate the inflation, even those are reflecting the debasement of the U.S. dollar at this point. But let's take a look back at this chart here. So the cup and handle formation, you know, we're seeing a little bit of a retracement in the price of gold. Right now it's around 2154. This is actually incredibly bullish for the price of gold. I mean, what you would expect on this chart here, you know, this handle, this level just under 2100 has served as resistance for a long time. I mean, for years. We've butted up against it multiple times. 1, 2, 3, 4 times. That intraday trading, we kind of surpassed it on a Sunday night, came back down, touched it again. Finally, we blew through it. Now, it's a very bullish development, but what would be the most bullish thing of all would be if we were to see the price of gold come back down to this level just under 2100, and that level now becomes support, right? So what was once resistance will now be support that we've blown through it. Once we bounce off of that, that's when we're going to see the real bull run take place. Now, I don't even know if we'll get down to that level. I mean, you know, if you're waiting for a pullback to 2100, you might be waiting a long time. But if we do see that, it is going to take off. Someone in the chat says, is it just always bullish? No. I mean, it's not always bullish, right? Like if the Fed began hiking rates to a level we actually needed to see to fight inflation, if inflation came down, if they paid off the debts, if they stopped printing dollars, then no, I would say it's not bullish for gold. But from a technical and a fundamental standpoint right now, there's a very bullish picture being painted for gold. And it could very well be that when we get this retest of this $2,100 level or so, could go slightly below that, and then we bounce off of that. That could be the moment that silver really joins the party. And gold, I think, is just going to absolutely explode. Of course, if you want to get some gold or silver, gold is cheap right now. Silver is dirt cheap at its current valuation, and premiums remain low, showing that the retail public, the retail investors, have not really moved into this market in any significant way. SD Bullion, you can get silver bars, 89 cents over spot. If you want to get some pre-1933 gold, they got these double eagles on sale. You got $0.50 for $1.99 over spot. I mean, clearly the public has not gotten into this market in a big way, and when they do, you're going to see these premiums move in a significant way. That's how you'll know it's really underway, but it hasn't even started yet. So if you want to get some gold and silver before that happens, make sure you check out today's video sponsor, SD Bullion. There's a link down in the description. Now, if we take a look at the CME FedWatch tool here, this is kind of an anticipation of what the Fed is going to be doing in regards to rate cuts moving forward. And now you'll see that it's not until June that markets are anticipating that we're going to get rate cuts from the Federal Reserve. But ultimately, I mean, it doesn't really matter when the Fed cuts. Certainly, I think that they will cut. Now, if they want to actually fight inflation, they would have to hike rates from here, not just delay cutting them. But there's no way they could do that. I mean, these markets have already priced in the anticipation of rate cuts in 2024. That's what Jerome Powell was telling us. If the Fed just reversed policy now, tells us that they're hiking, I mean, everything would implode. That's what's needed to fight inflation. They're not going to fight inflation. I mean, let me know what you think. If you think they're going to prioritize fighting inflation over pricking the bubble, put a 2. If you think they're going to print as much money as they need to keep these markets afloat, put a 3. Because I think that's what they're going to do. I would be in that camp. Now, let's talk about why that's basically inevitable. I mean, first of all, you've got the U.S. national debt now at $34.5 trillion, halfway to $35 trillion. We'll be hitting that this year. There's almost no doubt whatsoever. Ultimately, all of this massive deficit spending is going to lead to the Fed running their printing presses in an enormous way to prevent interest rates from spiking on U.S. debt. You know, you keep borrowing and borrowing. There's less entities around the world interested in buying U.S. treasuries. And that means someone's going to have to buy all of this debt. Who's it going to be? Are you out there buying U.S. treasuries? I'm not personally. Ultimately, we know who's going to be buying it. It's the buyer and lender of last resort, the Federal Reserve. And there is no chance that the deficit spending is going to slow down anytime soon. I mean, forget the unfunded liabilities in the U.S., which now total about $213 trillion for all of the domestic entitlement programs, all of the pensions, the Social Security, the Medicare. All of these things are just, you know, completely unaffordable. There's no way we can tax enough to pay for all this stuff. So ultimately, they're going to print the money. But even just on the geopolitical front, look at what's going on. You've got the Polish foreign minister now, according to this report here in the Kiev Post, saying that NATO soldiers are already present in Ukraine. The statement comes amidst growing discussions following French President Emmanuel Macron's recent remarks regarding the potential deployment of Western troops in Ukraine. So, look, NATO soldiers, they've been doing what these, they call them sheep dip mercenaries, where they take troops, kick them out of the military, have them call them mercenaries, and then put them in there so that they're not officially fighting for their nation state. That's been going on for some time. It's only a matter of time until NATO begins deploying troops to Ukraine. There's no sign that this conflict is going to de-escalate anytime soon. According to the Polish foreign minister, they may already be operating there. So expect trillions of dollars more of money to be poured into these wars around the world. The fact that NATO troops there are potentially operating within Ukraine, I think, is an obvious sign of a significant escalation. This thing's not going anywhere. There's also a looming massive escalation in the Middle East between Israel and Hezbollah in Lebanon. This report from 7 hours ago, Hezbollah fires wave of missiles at Israel in escalating battle. So, you know, the inflation data that came out today, they said energy prices and gasoline were contributing to the headline CPI moving higher than expected. Well, you ain't seen nothing yet when it comes to that, because if we get a regional war between Hezbollah in Lebanon and Israel, you're moving much closer to the potential involvement of Iran in this conflict in the Middle East. That means potential strikes against Iranian oil infrastructure, the likes of which Lindsey Graham was calling for since October. Iran produces something like north of 2 million barrels of oil per day, so that'll put a huge hit on global supplies, but that's nothing compared to when Iran ultimately closes down the Strait of Hormuz, where something like 20% of global oil production flows through daily. I mean, you can imagine what that's going to do to energy markets. And, you cut off 20% of global oil supply, even temporarily. That doesn't mean a 20% increase in oil. I mean, that could mean a doubling, a tripling in the price of oil. It's going to lead to massive inflation. There's nothing the Fed can do about these things, right? I mean, we're printing money on one hand to fund these conflicts. The conflicts are escalating, will likely lead to significant supply chain disruptions moving forward. Higher inflation is baked into the cake. And when investors get wind of that, when they understand where this is headed, well, you can expect the price of gold to ultimately blow much higher and blow through the roof. I've talked about the price target for gold based on the chart that we're looking at, the technical patterns there. You're looking at gold north of $3,000. If you want to know what the catalyst to drive it there could be, well, look no further than what's happening in the Middle East right now. So according to this report, Hezbollah launched more than 100 missiles at Israeli military sites in one of the group's heaviest assaults in recent months, threatening to escalate an already simmering conflict. At least 10 people were injured in another Israeli assault Tuesday on a town in the same area in eastern Breakout region in Lebanon. Now, this is one of the deepest strikes into Lebanon thus far. It's around 80 kilometers from the border, deep into Lebanese territory. You've got the Israel National Security Minister saying, what are you waiting for? More than 100 missiles on the state of Israel and you sit quietly? Let's start reacting and attacking. And, this is likely what we're going to see. An IDF invasion into Lebanon to push Hezbollah back away from the Israeli border. Again, you're going to see billions, trillions of dollars poured into this conflict. There's no end in sight. The debt is absolutely exploding. This is the U.S. Treasury's debt to the penny website. So we're less than a quarter of the way through the year. I mean, we got January and February down. The most recent data here is from March 8th. U.S. national debt there sitting at $34.46 trillion. I mean, today we know it's over 34.5. Gives you an idea of how fast this is accelerating. But let's just go back to the beginning of the year, to January 1st, and let's get an idea of where January 2nd here, where the debt was 33.99. So, we're about 2 months into the year, and we've racked up another $500 billion in debt. I mean, this is exponentially increasing, the rate at which this debt is exploding. And ultimately, as that trend continues, as the amount of debt being issued, the amount of deficit spending escalates, that is going to drive interest rates higher. The Federal Reserve is going to have to come in here and intervene eventually. We're going to face a massive debt crisis. That means the price of gold and silver are going to be headed much higher ultimately, and the value of the U.S. dollar is going to be dropping. We've got the most recent U.S. Treasury monthly report. You can see that for the month of February, the U.S. deficit was at $296 billion. Now, if you annualize that, that gives you a deficit of like $3.5 trillion. So, again, what was the story we saw last week? That the Treasury is racking up $1 trillion in new debt every 100 days. I mean, that is truly incredible stuff. You consider the fact that it took something like 206 years to rack up the first $1 trillion in debt from the date of the nation's inception. Now they're doing it every 100 days. Think about that. Think about the exponential nature of the increase in the debt, which ultimately will lead to money printing. What's that going to do to the dollar? What's it going to do to gold? What do you think? Where do you think we're headed from here? This is from the Financial Times regarding Joe Biden's budget plan. Joe Biden proposes higher taxes, spending, and debt in a $7.3 trillion budget. So the political elites have no plans for stopping. The current president unveiled a $7.3 trillion budget plan for 2025, which would put U.S. debt over 100% of gross domestic product, as the president laid out a fiscal agenda that boosts spending, but plans to save $3 trillion through higher taxes over 10 years. Well, one thing about government forecasts is that they're always incredibly optimistic. We've discussed this in the past. If you go back and look at the projections from a decade ago, they all said that we'd have $20 trillion in debt right now. What are the actual figures? I mean, much, much higher than that. And, they think they can just hike taxes and keep revenue going at the same rate. But the thing is, you hike taxes too much, you eviscerate the economy, you reduce your tax base, then tax receipts actually begin to decline. And that is the problem with what's going on. Of course, they say it differs significantly from the other candidate here who's vowed to renew the sweeping tax cuts enacted during his term in the White House in 2017 and limit government spending. Well, I believe that if we get a Trump in the White House, we could very well see sweeping tax cuts, although I don't really buy the limiting of government spending. I mean, if you look at the first term the guy had, he did cut taxes, but he just massively expanded government spending at the same time, enormously inflating the U.S. national debt during his term in office. And look, I know some of you are probably triggered out there, but that's just a fact. It's not really an opinion. And that means when you do that, when you just cut taxes, which is good, I mean, cutting taxes is good, but when you don't simultaneously cut spending, that means that all you're doing is you are paying for all of that spending via the hidden tax of inflation. So again, inflation, no matter who gets elected, you're not going to fix this in an election. It's not happening. Regardless of who's in the White House, the game plan is to debase the U.S. dollar. And the Federal Reserve, they basically tell you that as much when they set a goal for a 2% annual inflation rate. I mean, sure, they're massively exceeding that right now, but even if they get down to their target, that just means a slower debasement of the dollar's purchasing power, not stable prices as their mandate would indicate. Of course, we're going to be getting much higher rates of inflation than 2%. In fact, we're getting much higher rates of inflation right now than the official CPI tells us. However, investors are still getting this wrong, right? Investors see the CPI coming out hotter than expected. And what do you see? You see gold sell off. Now, when that dynamic changes, I think there's going to be a big move in other sectors as well. The miners, the producers of gold, the silver price also is going to be moving. Right now, despite the fact that gold is sitting at basically record all-time highs. I mean, it's higher than it's ever been before. Sure, we were over 2,200 briefly in intraday trading last week. Now we're at 2,150. But I don't think that is indicative of any kind of a major sell-off. It's just a little bit of a retracement. We could go a little bit lower, and if we do, that in fact would be bullish. There's been a lot of buying in gold in the past week. It's gotten a little bit overbought. This helps unwind that a little bit. We touch this line here, bounce off of it, and it is off to the races, folks. So time is short to get your position in gold and silver. It's not financial advice. I'm not telling anybody what to do. I am looking to buy this dip myself. I added to positions in some miners. Today, we got a little bit of a pullback there. I've got some physical metal on the way as well, some more junk silver heading my way. I think that's the sweet spot right now, the best thing to be picking up. But look, when the average investor begins buying into this market, I mean, they're behaving like the way you would expect investors to behave near a market bottom right now. There's not a lot of enthusiasm. I don't see a lot of people outside of the stacker community really paying much attention to the fact that gold is breaking out right now. That's a sign that there's still a lot of potential buyers who can come into this market and drive the price much higher. And that is, I believe, what we will be seeing as this plays out. So let me know what you think in the comments down below about these developments, about the exploding U.S. national debt, about inflation, and about the price of gold and silver. And please smash the like button on the video, subscribe if you haven't subscribed yet to get more videos like this. And I will talk to all of you again very soon. Thanks for watching. Stay safe and happy stacking, everybody. Smart Silver Stacker.